Hello, everybody, and welcome to another Saney's Lunch and Learn in our ongoing Financial Friday series. Saney's is excited to offer these sessions in cooperation with our partner, Equitable Advisors. Equitable has a long-standing presence in New York, and a large portion of Equitable's New York client base is built upon the work they do within the public education system. Through Equitable, Saney's members can receive competitive insurance rates and a full array of retirement services, including a complimentary financial profile for Saney's members, which we urge you to take advantage of. It's a great benefit. Our Equitable presenter today is Greg Ronneberger, Equitable Advisors Regional Vice President. Before we get started, please note that participants are muted during the session, but we will have some question and answer time following the presentation. If you have a question, just type it in your Q&A panel. We're also recording the session and it'll be available at saneys.org. And with that, I'll turn the presentation over to Greg.
All right, Annika, thanks so much. And I really appreciate everyone hopping in here. And I'm really excited to share some information with you all here. So before I go ahead and share the screen, just want to say one thing before we start here. Well, maybe two things. Number one, feel free to ask questions in the Q&A box. If there's something timely, Annika will see it and she'll interrupt me. I definitely don't mind being interrupted in the middle of this. Also, there is a chat feature. I'm going to ask a question a little bit in here. If you could put a yes or no answer in the chat, that'd be great. Just want to get a pulse of what people think about a certain topic here. Second thing is we do want to just extend our appreciation to all you folks for what you're doing right now. As a parent of two school-age kids, it's certainly tough. It's to say unprecedented is an understatement, certainly. But what you folks are doing is highly appreciated by people like myself. So I know you probably don't always hear that a lot. We always hear about everything we're doing wrong, but you're doing a lot of great things out there. So definitely appreciate it. So let's jump into this presentation right here. And I've got about probably 80 minutes of content that I'm going to try and do in about 22 minutes right here. So we're going to jump right into it. So when we look at helping folks like yourselves in what we call the early career administrators plan, how do we build a plan? So first and foremost, what we see from an approach, we see two different approaches out there that people take to planning, what we call the common approach and professional approach. And a common approach typically starts by people taking more of a product-driven approach, just accumulating different things as they go on through life. Having the pension through the state pension system, picking up a 403B, maybe a spouse or a significant other has a plan. So that becomes just a portfolio by design, but there's no real strategy involved. And this is a type of plan that you could see if you put an upside down pyramid on a flat surface. It's not very stable. The strategy is really the foundation of somebody's plan. And that's what we really want everyone to build, is a nice solid foundation. And the foundation to your plan is that strategy. Looking at your goals, your concerns, really determining what the best course of action is in all these different areas that we're going to look at. Once we know what the strategy is, we could build and design a portfolio. So any plans that we put in place, any recommendations that we might make to our clients or that you might take a look at, we make sure that the products fit the overall strategy and make sure everything is working together cohesively. So another way to look at this pyramid here is in building out the base of the pyramid, there are things that we need to definitely address. So what do we need to address? We need to address three, what I call foundational pieces of somebody's financial plan. It's having a savings strategy, it's having a retirement strategy, and it's having a protection strategy. And we're going to look at these three things one by one here. So from a standpoint of a saving strategy, typically, and you probably have been through different presentations or heard different people talking about having 3 to 6 months worth of expenses in an account. And I apologize if it's a little sloppy here, but I think you get the drift. So why is that important right now, especially over the past year or so? I mean, who would have ever thought school would be shut down? Who would have ever thought we couldn't leave our house for 3, 4, 5, 6 months? Who would have ever thought that my daughter is in junior high school and she's only going to school on a Friday every single week. What's happening now and what could happen in the future, what happened in the past, is that if something shuts down at a moment's notice, fortunately in your environment, you haven't seen much in the way of, say, furloughs or position eliminations, but that could come. So what happens if district budgets get cut and someone comes in and says, hey, gee, we're really sorry. Now, a lot of you folks being early career administrators, you know that the last one in is typically the first one out. So what if a position gets eliminated, worst case scenario, from a job standpoint at least, and all of a sudden you're out on the open market? Well, it's not like there's going to be a lot of opportunity out there in the short term to pick up another job. So we want to make sure that we have enough in the savings plan to compensate for something like that. From a retirement standpoint, I get it. We'll want to retire yesterday, especially with what's going on right now. But it is nice to have, we'll talk a little bit more about the pension plan. You've got your 403Bs. Maybe you have other savings plans. Maybe, again, you've got a spouse with a 401k, some IRA plans. These all factor into your retirement strategy that you want to take action on. And then protection. Let's protect the things that we can't afford to lose. And what are those things? Our health, our ability to work, and our lives, certainly. And again, we'll dive more into that a little bit. So I think the savings is pretty self-explanatory. What about the retirement here? That's what most people want to talk to us about. And starting with the pension, many times we'll ask people, what pension tier are you in? And they kind of stare at us and say, well, the New York State pension system. And no, there are different tiers involved there. Just very quickly, here are the different tiers. Some of you may be tier 4. Very few of you might be tier 5. And I remember when tier 6 first came out, as we're getting started with that, say 2013, 14, nobody was in tier 6. And now it's, 9 years later, almost 10 years later. And I'm getting older because we're seeing more and more tier 6 members there. What's important about the tier that you're in is how the pension is calculated, as you may know, and when you can retire with full benefits. And tier 4, still pretty decent, where it's age 55 with 30 years of service or age 62. So if you're 57, 58, you hit that 30-year mark, and then you could retire with your full benefits. Tier 5 bumped it out just a couple of years, but look at tier 6. If you're tier 6, you got to go to age 63 to get your full pension benefit. Now, does that mean that we need to necessarily work until 63? Not necessarily, but many of the tier 6 members we talk to don't get super excited when they say, well, gee, I started at 23 years old. I'm 12, 13 years into the career, and you're telling me I got to go another 28, 29 years to get my full pension benefit. That's where people typically start crying in the meeting room here. But there are some strategies around there that we do want to take a look at. So as we're taking a look going through this, so let's take a look at the retirement sources right here. And this is where I do want everyone, just if you can, if you open up that chat box right there, just a simple yes or no. I just want to ask on Social Security. Are you counting on Social Security for your retirement income planning? Just a quick yes or no. You don't need to go into full detail on your thoughts about it. But from a standpoint of your pension in looking at your New York State benefit, sometimes a matter of perspective. And most people look at this as a huge positive, and I think we should. But when you look at your pension, we say, hey, great, that is a fixed amount of money every single month that will last as long as you do. You don't have to worry about it. So that's great. That's on a positive. So you get a fixed payment every single month. Well, the pessimist might say, if you look at a glass half empty, might frame it this way. Hey, you're going to get your pension. I mean, it's a fixed amount each and every month. It's never going to change. So you're going to get that fixed amount of money for the rest of your life. So why is that a bad thing? Well, we have to look at what our needs are. So if we look at our need in retirement time, we really have typically 3 different phases in retirement. We have what we call sometimes our go-go years. And these are the years that early on in your retirement, you're going to get out there, you're going to want to travel, you're going to want to do some things. Maybe you're visiting your grandchildren, buying them a bunch of gifts and all that. So what you need from an income standpoint, plus inflation is going to happen as well. Prices are going to go up each and every year. So you're going to be in some type of situation like this as far as what you need for retirement. You get to a certain age, then you start to slow down a little bit. Well, the slow go years, we're not taking as many trips, we're not being as active, but maybe some of the things that we're doing are a little higher end. So we're only taking 1 trip, but it's a really nice trip each and every year. So the amount that you need might go down a little bit, but still going to increase certainly over time. And then as we get into our kind of golden years, then we got the no-go years. And the no-go years, we're sitting at home a lot. We really don't spend a lot of money necessarily. Maybe our homes are paid off and we don't have a lot of bills and expenses. So our spending might go down a little bit, but we still have inflation and we also have healthcare costs to worry about out there as well. So your income need throughout your retirement years might look something like this. It's typically not a linear going up each and every year. So when we look at what we have available to us, let's say that your pension is at this level right here. Well, that's not too bad early on because we're saying, hey, we've got some money, we've got enough to cover. But what happens down here? What happens when that pension is not enough to cover our expenses? What if you don't have as many years in the system? Maybe your pension is down here. And again, your pension typically doesn't increase. Now, there's a cost of living increase on the state pension, but it's not really a whole lot. It's not really much to speak of. So you definitely have some gaps here that you need to cover as far as what you need. And that's where these other sources are going to come from. Now, Annika, just real quick in the chat, did anyone put in any ideas in the chat as far as if they're counting on Social Security or not?
Yeah, we got quite a few answers. Majority no. We have 40 no answers and
Wow.
Just 8 yes answers.
All right. Well, thank you, 48 people for responding. That's way more than I thought would do that. But overwhelmingly, a lot of people are not counting on Social Security for any type of income for retirement time. Many people just see it as a bonus if it comes in. But that really puts the pressure on our savings plans, say those 403B plans, 401ks, IRAs, all those different types of plans to make up the difference there and make up that deficit. Because again, if we have a fixed amount of money coming in from the pension and retirement time, and we need more in a certain month, or we need more to do a special project, fix the house, buy a new car, whatever we want, it's not like we could just go to the pension system and say, hey, can you give me a little advance on my pension for next month? I need the money right now. So we can't do that. So as we look at what we see, for most people, the pension is a very large part of our benefits, or of our, I should say, of our income in retirement. And typically a small portion is from their savings. Now, what we'd like to do certainly is to maybe make that savings part a bigger part of someone's retirement income there, so that there's more flexibility down the road. We have more of an opportunity in order to generate some additional income come retirement time. And why, for those that are, again, early career administrators right now, where that's important too, is when you look at when you could start taking your pension. So if we look at the Tier 4 members, if you have 30 years of service, you could start taking right here. Of course, we mentioned the Tier 5, you could take at 57, but those Tier 6s, you're waiting until 63 to get your full pension benefit. Now, as I mentioned before, if someone starts at, say, 23 years old in the state retirement system and you say, hey, I'm 35 years in, that puts me at age 58. And, I just can't see myself going another 5 years in the system. Can I retire right now? I have enough accumulated benefit. I just want to get out. And we say, yes, you can retire at 58 from the state system. But what is that going to do from a pension standpoint? Anytime that somebody retires and elects their pension benefit without hitting, I'll go back here, without hitting these milestones that we talked about, there's going to be a reduction on the pension payout. And what do those look like? Well, they could be pretty significant depending upon when it happens. So for a tier 6 employee here, so it's 6s on the right-hand box there, you can see it's 6.5% per year. So if someone said, well, I could go to 58, that's about a third is going to get knocked off of the pension. And that is a lifetime election. It's a lifetime reduction. It's not like every year you go on, you start to get more and more. That's set for life. You can never get that money back. You can see the other tiers as well. They're pretty significant. You're looking at 6 2/3 to start out on the tier 5, and then it goes up, but it's still 5% each year from there. Tier 4 isn't quite as bad, where it starts out 6% per year, then drops down to 3% per year as you go earlier. So if we're in a situation and somebody says, and again, regardless of the tier, where we say, I want to retire here at 58, for the 8 of the 48 that said, hey, I'm okay with using Social Security and putting it into my benefit plan, or at least my calculation, the earliest you could take Social Security is age 62. Now, I can retire at 58, but I could delay my pension until 63. I don't have to take it right away if I don't have the years of service in. And this counts for tier 4 and 5 members as well. If you don't have the full years of service and you have to go to 62, 63 for your benefit, you can retire when you want to. You just have to not take your pension election yet until that full age 63. So let's say that we're in this situation here. We're earning our income until age 58. And then at 63, now your pension is going to start. Well, okay, what do we do in this time frame right here? Now we've got a gap in income. And that gap, what we need to do is to build a bridge. We need to build an income bridge so that we could get you from 58, say, to 63 until you could take your full pension. Because to take a third reduction on your pension is just crazy to do. But we get it. 35 years in the system, I mean, that's a long time. And to go another 5 years, many people might not want to do that. So if we're looking at your pension, so now your pension is going to come in at age 63, let's say. Social Security, we're going to say, you know what, that's a bonus. We're not really going to count on that, maybe. So now we really need to make sure that we have a good saving strategy there. And what are the types of plans that we need to have inside of the saving strategy in order to build that bridge? And if I'm looking here, and let's just say, for example, that I need, in order to live my lifestyle, I need $50,000 a year to make up a number, okay? So I'm looking at $50,000 per year. Well, if I need to pay tax on that money, I probably need $62,000 to $65,000 each year to generate that 50K. Because I don't know about the rest of you, but if I look at what's going on in the world right now, and I look at tax rates right now are actually pretty low from a historical standpoint. Going forward, imagine 25, 30 years from now, someone knocks on your door or gives you a call and says, hey, we've got this bill that you need to pay. And you say, where's that bill coming from? I don't recognize this. Oh, it's not from you. Your grandparents needed some money 25 years ago, so they put a bunch of money on credit cards. And, someone's got to pay for it. And they said, don't worry, my grandkids will pay for it 25 years from now. Well, does that make any sense? No. Could that happen in that exact situation? No. But, think about what's happening right now with all the stimulus money that the government is putting out into the economy, just running up these huge deficits, doubling, tripling our federal deficit in order to get money into the economy, someone's going to have to pay that money back at some point in time. So it's akin to people putting money on credit cards today, and then someone's going to have to pay the bill 25 years from now. Paying that bill 25 years from now is going to come in the form of, I think, increased taxes. Now, can I guarantee you this? No, but I just have a feeling that that's going to happen. So as you're building out your plan, look at tax diversification as well, and look at, we might have heard of traditional versus Roth options. Your 403Bs, if you have, or maybe a spouse or someone has 401k plans, IRA plans, these are plans that are pre-tax in, so you save tax money today, but you pay tax on the way out. Okay, so all this money is taxable, and this is what most people do. Most people in the school system save as much as they can in their pre-tax 403B, and then all that money coming out is taxable. But guess what? Your pension is also federally taxable, and your Social Security, if you receive that, is going to be taxable as well. So if we could tax hedge a little bit, some districts have a Roth 403B. They all should have it, but that's another story. You could also do Roth IRA plans. And these plans are after tax in, and then they're tax-free coming out. So we want to make sure that we are tax hedging our savings today in order to generate some tax-free income in retirement time. It's going to be very important for us as well. So if you look at this, this is very busy. Not going to go through all of it here, but there's just 4 different tax boxes as far as how accounts are taxable. Again, looking at pre-tax contributions and taxable at distribution, that's where 401k plans, 403b plans typically sit. But if we could build some money in some of these plans here, Roth IRA plans, Roth 401k or 403b, cash value life insurance is another great way to get some tax-free income out in retirement time. So as we're building our income plan in retirement time, we're determining, all right, if our income is, let's say our income need is this line, let's just say. All right, well, maybe the pension, maybe this is our pension income. And maybe, you know, this is our Social Security income here. And then our savings plan is going to come from, running out of colors here. So maybe our, here is our Roth distributions, and that's going to go on here. And maybe our pre-tax, this is the one my kids like because it's very colorful, this ink right here, not the pre-tax or the after-tax money, but the colors of the pen here. That's where we use our pre-tax plans in order to fill those gaps too. So we can simply just save a bunch of money in these different plans, in these different retirement plans, without really looking at you know, all the long-term ramifications of it. We could just build as much in a 403b as we can, but let's look to hedging some different areas for taxes, for timing of our distributions with the 403b, the pension, and all that. So we talked about savings, we talked about retirement. When we talk about protection, and I'm sorry I'm zipping through, the goal here is not to solve all the world's problems, just to give you some things to think about right here. When we talk about protection, we want to protect the things that we can't afford to lose. Your health, you have great health insurance through the district. Your ability to work, that's in a disability standpoint, which you have some benefits through the state retirement system as well. And then protecting your life if you were to pass away early and prematurely, and your family needs some money. So a couple things that go into this right here. Number one is, if you look at what your pension is worth right now, just from a benefit standpoint, if I were a 35-year-old tier 6 employee right here, so let's take Teresa Smith right here, and the pension is valued at $60,000 per year from age 63 to 95 with a small cost of living increase, I would need $300,000 today to put in Teresa's name, and we ran this at a 5% growth rate. So if I had $300,000 today, earning 5% per year, I could match that benefit right there. And then for tier 4, tier 5, because they're starting a little bit sooner at different ages, the amount of money I need is going to be a little bit higher. Now, when I get to age 55, so let's take an older Teresa Smith, so we go out 20 years. Now, in order to match that benefit for those years, I need $800,000 in my plan. And for tier 4 and tier 5, it's even more money that I need. So the reason this is important is, what if at age, whether 35 or 55 or any time in between, what if the person that is set to collect this pension passes away while in service? If that happens, the families that are counting on this money in retirement as well will receive 3 times that person's salary, which may or may not be enough to cover the expenses and to cover what this pension would be. So there are different types of plans. Just in the interest of time, we're not going to get into them right now, but why I think this protection part is so important right now. So again, just to get to these 3 pillars here that we look at, the foundational pieces of somebody's plan. People tend to do this, maybe not so much. They tend to really focus on this, but they tend to neglect the protection side. And what I say right now is that we don't know, if anyone could put in the chat, if you know exactly the ramifications of COVID-19 for someone 20, 25, 30 years from now, if you know the impact of getting the injections, the vaccines every year for 30 years, if you know exactly the impact that's going to have on our long-term health, then I think that's fantastic. I'd love to talk to you about that. But I don't know, and I don't think the insurance industry knows either, to be quite honest. But right now, there are companies that are still not factoring that in because they don't have the experience, the exposure yet. But what if 15, 20 years from now, it's determined that there are some ramifications from people that had COVID-19 back in 2019, 2021. That's going to have an impact on how they insure people down the road. And I heard a stat where something like 30% of the population got COVID-19, has had it. Now, certainly not everyone was as sick as some others, but if all of a sudden we go out and 30% of the population, 40% of the population had COVID-19 and they were exposed to it, that's going to make it much, much harder for people to get insurance in place when they decide they want it. Everybody wants it when they can't get it. But if you're young, you have health on your side, now would be a good time to really take a look at something like that. So to kind of wrap this up here, right now, as if someone's looking at their plan, you might say, you know, I've got my pension, I've got a 403B, I feel like maybe I'm doing okay. And now Greg's telling me, all right, pension, 403B is nice. Maybe I should have some Roth savings, some after-tax savings. Maybe I need to look at my insurance portfolio right here. And I start doing all these things kind of in a vacuum of each other, and I silo my plans here. Well, you're going to have a plan that, you know, maybe is cohesive, maybe not. But remember this professional approach here. Remember what we talk about as far as really wanting to build a solid strategy for you with that foundation being right there under the strategy. So let's get everything cohesive. Let's make sure that if we have all these different plans, pension, retirement, savings, and all that, what if we can get all this so that we hit that sweet spot right in the middle? Everything's working well together. Everything is doing what we want it to do. We have a really good, solid game plan for it, and that puts us in good shape for the future. And that's really the area where we could help the most people out in. So in wrapping up here, these are your regions, and these are the folks that serve your regions. So if you're in one of these areas and you feel like, you know what, I might need some help on some of this stuff and I need to reach out to someone, these are the people that you would reach out to initially to start having that conversation. So I'll leave this up here for a minute. And Annika, it's 12:30 and I went a little bit over, but hopefully people could stick around if there are questions in the chat. I love getting questions. I'm certainly willing to stick around and answer anything that anybody has here.
Yes, thanks, Greg. We do have a few questions. One couple people asked if it's also possible to get a copy of the PowerPoint in addition to viewing the webinar.
You know, it's really hard to give a copy of the stuff that I wrote out because you know, I just drew it all out here, and it a lot of times doesn't make any sense for people as they're seeing it afterwards. But these, now this was recorded, right? Yeah, this is recorded, yes. And Sainies does post the recording to their website, so you are able to get the, you'll be able to rewatch the presentation. If you could stand listening to me over and over again, you could actually, you could rewatch the presentation again.
Okay, and then the next question is, do you have to pay taxes on your pension?
Yeah, your pension is federally taxable. It's not state taxable, being in New York State, but you will pay federal tax on your New York State pension. Yep.
And then sometimes the state allows early retirement. Does that mean that they do not reduce your pension if you meet their guidelines?
Correct. So if the state does a retirement incentive, sometimes what they'll do is they'll say, we'll give you an extra couple years of credit service. So if you have, let's say, if you're tier 4 and you have 28 years and you're 55 years old, they'll say, well, we'll credit you an extra 2. We won't give you a reduction if you don't have the extra years in. What I have not seen them do is say, yeah, we're just going to forego the reduction. Yeah, retire 5 years earlier if you're tier 6, and we won't worry about that 32.5% reduction. I wouldn't bank on that. But you know, occasionally they throw something in there where they say, hey, if you don't hit the full years of service, we'll let you go ahead and retire with the full benefit. There is legislation in Albany on a retirement incentive, but it's been there a bit. It hasn't really moved anywhere yet.
Okay, and then another question about the tiers, and just to confirm, a tier 4 member who retires at 55 with 30 or more years earns 100% of their state pension, and there's no penalty or reduction?
That's correct. Tier 4, age 55 and 30 years of service gets you a full pension benefit. That's correct.
Yep. Okay, and then the next question is it common for districts to include a 1% cost of living? Could this potentially be 0%?
Is it common for a district to include a, I'm going to read that question here.
It's in the Q&A.
Yeah. Is it common for districts to include a 1% cost of living? The 1% cost of living, I'm guessing what that's referring to is the cost of living increase on the pension, which is, it's part of the pension law, which states that the increase on the pension is half of the cost of living increase, but it's only on the first $18,000 of someone's pension, and it doesn't kick in until age 62 or 5 years of receiving the pension, whichever is longer. So it's not really that great of a benefit. It's, I mean, sometimes if it's in there, it might be, you know, 15, 20 bucks a month of an increase. So it's not really something that I like to count on from a cost of living increase on the pension. Hopefully I answered the question the way it was asked here.
Mm-hmm. Yep. Does anything happen to our pension if you move out of New York State or outside of the United States upon retirement?
Yeah, I get to keep it, is what happens. But, you know, seriously, I wish. If you move out of New York State, of course, you still get your pension. Federal taxes still apply regardless of where you live, but your state, depending on the state you move to, state income tax might apply to your pension. My stepfather lives in Florida right now, where most of New York goes to live in retirement time. There's no state income tax there, so his pension is not state income taxable. But if you move to a state with a state income tax, then they would tax or may tax. I'm not a tax expert in all 50 states or even overseas. What happens if you move overseas, that's a little outside my scope of knowledge there, but I think in that case you have to still file a U.S. tax return and a tax return where you live. I'm not really sure on that one, but you're not avoiding the taxes by moving, say, to Canada or Australia or something.
Okay. Will Fica and Fica Medicare taxes be deducted from my Nistrous pension when I retire? And they currently have $450 taken out of each pay.
Right, not from your pension, your FICA, your Social Security, and your Medicare tax. Those are only taken out of earned income. Your pension is not earned income, so it is not taxed the same way in that regard. You will have to pay, don't forget, you have to pay Medicare costs. And if that's coming out of Social Security, great. If not, you might have to pay it elsewhere. But no, FICA and Medicare taxes, the payroll taxes are only on earned income. Now, many of you will have a part-time job, maybe do some consulting work in retirement as well. And if you're doing that, then that income will be taxed, FICA and Medicare tax.
Okay. Why should I invest money in a 403B instead of investing in the stock market?
Well, a 403B plan has many different investments inside of it. So think of a 403B as just a tax wrapper around the investments. So essentially, if you invest in a 403B, you can choose to invest in funds that do invest in the stock market. You could be very aggressive, very conservative. I could have the same investment in a regular investment account, in a Roth IRA, in a 403B. It's all the same investment. It's just they're treated differently from a tax standpoint.
What is the recommended percentage of your salary that you should be putting into your savings / 403B?
Yeah, that's one we get a lot. And I would say it's different for everyone, but a rule of thumb, 10%. If you want a general industry rule of thumb is save 10% of your pre-tax, your gross income into a retirement plan, some type of saving strategy. Now, depends on what you want in retirement. If you tell me you want to double your income in retirement, you're going to need to save more than 10%. So it is situationally dependent, but if you just want a ballpark, 10% is a good number to start with.
And another person is asking, can you talk more about the difference between a 403B and a Roth account? They were told that they didn't qualify for a Roth.
You might not qualify for a Roth IRA, and this is a pretty involved part of this, so we won't go too in depth here, but there are Roth IRAs, which do have income limitations. If you earn over a certain amount, then you may or may not qualify for that. Roth is just after tax. Again, it's after tax money that goes in, tax-free distributions coming out. Whereas your 403B, in a traditional, what they call a traditional sense, pre-tax going in, taxable coming out. Districts are starting to add Roth 403Bs more and more. That allows you to save into a 403B in an after-tax environment and have that money come out tax-free. I would say if you ask your district if they have a Roth 403B option. If they say no, ask them why not, because it's really easy to set one up. They don't have to hardly do anything to do it. Sometimes it just has to come from your bargaining unit where you have to ask for it as a unit or include it, but it benefits all employees. It's something easy to do, and we're trying to get more and more districts to have that. So that will help. If you don't qualify for a Roth IRA, you can utilize your Roth 403B. But again, there are other types of plans in that fourth box there, that tax box, that we could utilize to mimic that type of benefit. So, that's a real loaded question that could go a lot of different ways.
Okay, is it to figure out possible federal tax withholdings, should we use 20% as a guide?
That's a safe number to use. Yeah, I would say if you're just doing pre-planning work to figure out what your income is going to look like, what your distributions are going to be, I would say 20% is a safe number.
And can you get a Roth on your own?
Yeah, a Roth IRA is IRA stands for individual retirement account. It's outside of any employer plans or anything of that nature. It's just something you do on your own.
Yep.
So can you do it on your own? Yeah, you could go online and set up a Roth IRA. You could do it through folks like us. Advisors could help you with it. A lot of different ways to get that. You just need to make sure that you qualify for it And that's where advisors could come in and help you work through the numbers to make sure that you do qualify for the contribution.
Who do you talk to when you're trying to gather all the numbers? They worked for 13 years out of state and now are here in New York. Would that be a financial planner? They're looking for the numbers for.
Yeah, those are things that we could help with, coordinating all those different benefits, and that's where again that pyramid comes into play. Developing the strategy first, and it's gathering all the information, getting all the numbers in place that you have to work with. The more difficult the situation is, the more moving parts there are. I think having an advisor becomes more and more beneficial.
What if you're tier 4 and retire after 55 to reach your 30 years? Do you get 100%?
If you're tier 4, retire after 55 to reach your 30 years. Yes, it's any 55 or later. So if you hit 30 years at age 57, full benefit at that point.
Another tier 4 question, actually a few tier 4 questions coming up.
Yes,
if you're a tier 4 and can collect at 62, is there any benefit staying until 65?
Well, every year that you work, you get an extra percentage added on your pension. And I'm seeing a lot of pension questions in here. A future session, I don't know if it's the next one or the one after that, but we are doing a pension maximization presentation. So I would encourage all of you that are asking these questions to attend that one, because we're going to dive a lot deeper into pension calculations, what it means to work past those times, how to maximize your pension payout. So, for some of these questions like this one, the next one is asking about what percentage does a tier 4 member receive. These are questions that we'll go over in our pension maximization one. There's so much to talk about here that we couldn't really do it justice just in this quick little Q&A.
What happens to my tier 6 pension contributions if I move before retirement?
If you are not vested, then you can take that money out and move it into your own individual retirement account. If you are vested in the pension system, and for tier 6, I believe it's a 10-year vesting schedule. So if you have 10 years in, you will receive a benefit. It's just going to be kind of small.
If you stop working at 53 with 30 years of service, I think that was already answered.
Yeah, so do you still get your full pension when you file your paperwork at 55? I believe so. That's one I have to check on, because you have 55 and 7. That's one I'd have to check on, and we could address that on the next pension maximization one.
And what is the difference between a 403B and a 457?
Briefly, they're very similar accounts. They do the same thing in that you can put money into a retirement plan through your payroll. What's great about working the school systems is that you can actually do both. You could double defer, it's called. So if you hit the maximum on your 403B and you want to save even more into a plan for retirement, you could add on a 457 plan if your district has it, and you could double defer. You could put more money into a retirement plan for yourself. So very similar plans work in conjunction with each other.
And the next one is, can you provide examples of the normal pop-up options that we would need to choose from that could impact our pension?
Yes, I would say that one we will tackle in the pension maximization workshop. There's, again, a lot that goes into there. There are a few different options. That's a pretty detailed conversation that we'll definitely hit on for the next one.
And then the final, another question is speaking to lowering an interest rate on a loan. I'm not sure if that's covered in here.
No, it's a little outside the scope of what we talked about here. Lowering the interest rate on an outstanding loan. If you're talking about a mortgage or something of that nature, you could refinance debt. Interest rates are very low right now. If it's personal loans, things of that nature, those are sometimes tougher to do, to get lower interest rates on. There are a lot of different planning cases there. So I would say for some of these questions that are coming in that are maybe more personal in nature, that are outside the scope of what we did here today, that we just didn't have time to talk about, you could contact Sainies and they could direct you to the person in your region that could help you out. Or if you jotted the names down, I could pull it back up here to take a look at the folks that are in your area that could help out. I think this is sharing.
Yeah.
Annika, the map here.
Nope, it's not sharing.
Oh, darn it. Okay.
Greg, also, if you could send me your copy of that particular slide so I can check it against what we have on the Sainies website, and then I'll go ahead and update that on the Sainies website as well.
Yeah, I think that is the one that's right on your website, but I'll double check. And my Zoom thing is frozen right now, so I'm not, I can't share anything.
Okay.
All right. In fact, I might drop off here if this thing doesn't fix itself.
Okay.
But I think we hit all the questions, which is fantastic. Thanks everyone for putting the questions in, and I really appreciate you all being here.
Yes, thanks a lot, Greg, for taking the time to do this. Again, you can go to the Sainies website for the list of Equitable representatives in your local area, and we'll be sure to double check that to make sure all that info is up to date. Thanks again, and have a great weekend.
All right, thank you. Thanks, everyone.